Urban Living webinar. Today we are going to be discussing real estate investors and where they are deploying their assets. My name is George Sell, editor of Urban Living News, and we are an online B2B platform for the hospitality and real estate sectors. Today's session is going to last around an hour. We'd like to make it as interactive as we can, so if you have any questions for our panelists, please do submit them using the chat or the Q&A functions in Zoom. And a recording of the session will be sent to everybody who's registered via email in the next couple of days. Now, this webinar series is sponsored by IMS. You can find more information about how to get in touch with them in the chat. And we are just going to watch a quick video to find out some more about what they do. Okay, thanks again to IMS. And as I said, if you'd like to find out more about them, you can see their contact details in the chat. So we've got a fantastic international panel here with a broad range of experience. And I'm going to ask our panelists to introduce themselves quickly in turn, and then we'll get stuck into the meat of the session. We'll go from left to right as we see them on the screen. So Laura, could I first ask you to introduce yourself, please?
Sure. With pleasure, and thank you very much, George, for having me. Laura Brinkmann, I work for KSL Capital. I joined them late last year in their strategic operating team. So I work with the deal team on our European portfolios to execute our strategic initiatives.
Thanks, Laura. We can't see. I don't know if your video is working, but she could have a.
I'm afraid I'm on two devices. Sorry for the technical difficulty. So I am on camera, but on my phone.
Ah, okay. All right. Well, welcome, Laura. Ioannis, good afternoon to you.
Hi, good afternoon. Ioannis Verdelis, Chief Investment Officer of Vita Group. Vita invests in the living sectors, predominantly student accommodation, student housing, as well as build to rent and co-living here in the UK as well as in Spain.
Thanks, Ioannis. And Susan, good morning, I should say to you.
Good morning. Thank you for having me. I'm Susan Tjarksen with Cushman and Wakefield. We work globally in build to rent, co-living, micro units, and traditional apartments, both selling them as well as financing them.
Thank you, Susan. And finally, Brian, good afternoon to you.
Good afternoon. Hi, everyone. I'm Bryan Oknyansky. I'm an architect, and I work at Studio Moren as a senior designer, working on hospitality projects, residential, co-living, student accommodation, a whole gamut. And working on refurb projects, retrofits, as well as new builds, a combination of the two, working with heritage sites. And my focus is designing the project for maximum success for getting over the line for planning so we can get buildings on site. And also as a sustainability champion at Studio Moren, really interested in the path that we're all facing collectively in regards to ESG, net zero, for the years ahead.
Yeah, great stuff. Thanks, Brian. And that ESG thing we will talk about later because it's a big influence on investment decisions at the moment. So I just wanted to show a few slides of screen grabs of news stories that we've run on our websites recently, just to give people an idea of some of the topics we're going to talk about, some of the asset classes that we're going to talk about, and some of the players involved. So we've got VC money here backing a co-living scheme in Sri Lanka, quite unusually. We've got the big institutional investors such as AXA IM getting heavily into multifamily and student accommodation. We've seen the 4th record year in a row for investment into the UK build-to-rent sector. Again, institutional investors here, PGIM, involved heavily in later living, finance for co-living, and LNG invested $5 billion overall in various forms of residential projects last year. But just to show that it's horses for courses and not everybody is pursuing the same strategy, these stories ran within a couple of months of each other. So we've got one investor moving into the PBSA sector while another one comes out to focus mainly on build to rent. So there's a lot of different things going on. So I'm going to stop my screen share and we're going to crack on with the conversation now. I want to start by asking about overall investor sentiment and investor strategies, and if they've changed with regards to hospitality and real estate over the last year or so. We've gone from an environment where we've had historically low interest rates for a long time. Finance has been easily available, but that's kind of that whole scenario, which did tick along for many years, has stopped quite abruptly. And I'm just wondering how that's affected investment strategies and sentiment. Laura, do you want to kick off with that one? I mean, KSL is obviously predominantly involved in hospitality and travel, and the end users of your assets are usually spending their sort of disposable discretionary income. So how have your investment strategies changed in accordance with the kind of geopolitical and economic factors that we've seen in the last few months or so?
Yeah, thank you. And you're correct. KSL has very much strongly positioned itself to be the leading luxury hotel, travel and leisure owner operator. And if anything, we haven't changed our strategy. We feel reinforced in our strategy because we've seen our customer being less influenced or differently influenced from some of these macro factors than the wider breadth of society or the cut of society. So we have tremendous exposure in the ultra luxury and full service upper upscale positioning. And 2021, 2022, and now 2023 is shaping up to be a meaningful year from an investment performance perspective. Now, we are dealing with the same headwinds that many other players in our industry are dealing with. So needless to say, we're trying to navigate, capital market changes, inflationary costs, the labor challenges that our industry is facing across the spectrum. So that is reflected in the investment profile. But we are continuing to be active, looking for new opportunities in that space. Right now, and I think we're going to come to that, everyone is probably struggling to cut out the financing portion of that makes a deal particularly attractive, but we're also seeing some improvements there. So our investment strategy remains confirmed and strengthened. We are active in the luxury affluent traveler space, whether that is across hotels or the travel, or for instance, also the recreational space. So we own, third space in London, which turns out to be seeing some of its best performance on record.
Mm. And what proportion of your strategy involves acquiring existing assets or brands, and to what extent are you involved in developing new assets?
It's a good question. I couldn't give you the exact ratio right now. We are absolutely present relative to our investments in both of those fields. So one being the established brands that we invest behind, such as the Pig Hotels, for instance. So brands that we believe have real true value, that have that call upon a massive loyal following, where we're not adding, specific intelligence to improve the positioning. We're backing the business and helping support from an infrastructure perspective, from a capital perspective, to take it to next levels. Whereas, we are very proud of what we've done with our Bormir platform. That was an investment that was acquired from Perseus Capital. We rebranded it, we defined the product positioning, we expanded the platform, and we're now very proud to see that the brand is developing following. We are absolutely punching at levels that we didn't expect to see, for such a young brand. Again, this is a luxury positioned French owner operator. We've moved into Switzerland. And so we really like both plays. Like KSL is very comfortable to deploy what we call, the strategic playbook, which brings best practice across the spectrum, as well as the financial acumen to design an investment in the best way. But at the same time, particularly in the US, but in Europe, we are backers of good and strong brands that have continuous asset lifecycle that we want to that we want to be a part of in their history.
Yeah, great stuff. Thanks, Laura. Ioannis, Vita Group is an interesting company because you develop and operate your own assets, and you're in different areas of the living sector, so student accommodation, as you mentioned, build to rent and co-living, which I think are all markets which still have a lot of potential for growth. They're undersupplied in a lot of areas. So how, if at all, has your investment strategy been affected by the economic headwinds?
Look, I think over the last year, across the real estate, we're having a number of headwinds in terms of costs. So you have inflation in construction costs that's hitting every sector. You have higher interest costs. You have, because of Bank of England and generally central bank rates, you have yields moving out. So there is a lot of headwinds that are being thrown at every appraisal that you're running. And you need to find the sectors or the segments where you can offset that with increased either exit values or sale prices or rents. So if we're in a rental sector, it takes quite a big rental jump to offset all of these headwinds to deliver new products. So in our branch, we're targeting the commonality between all of them is we're targeting premium sectors. So we're in the premium end of the student accommodation market, we're in the premium end of the build to rent and the living markets. And our experience operating those assets is we have completely outperformed on the rental income of those assets in the last 2 years versus where we would have expected 2 years ago. We're in double digits growth in terms of rental profile across all the brands, across pretty much the whole portfolio, and that offsets the headwinds on an appraisal, and you can still find viability in schemes. I think it would be much harder in sectors that are in retail or in offices, in places where you just can't imagine rents growing 10 and 15% year on year every year. There's just no way. So for us, in terms of our investment strategy, for the next 12 to 18 months, we see opportunity. We see, because at the end of the day, we're all competing for the same parcels of land, for the same contractors, for the same resources. So I think that's an opportunity for the living sector to continue growing, while perhaps other parts of the real estate will find it much more difficult. But you need to really look at your proposition and whether you can sustain sort of whether you can not be only the victim of inflation across the board, but also have some inflation in your own pricing, looking ahead to offset it.
So there are parallels between your strategy and Laura's in the hospitality space, in that your end user is somebody who is in a financial position where they're fairly well insulated from the fluctuations.
Yeah, they're able to afford at the end of the day, and certainly for our student brand in particular, the accommodation component is only a small part of the whole overall package of expenditure that the student undertakes to get into if they're coming to study in a new market from overseas. When you overlay travel, tuition fees, spending money, and so on, the accommodation is actually a small part of the overall budget that I guess parents have budgeted to pay. So we see, and there's a few other kind of macro factors, particularly in the student market, the opening up of China. So we've traded well over the last few years despite a huge restriction on travel, and despite and particularly affecting China. And I guess for hospitality, that I don't know, but that might be again the case. You still have a huge part of the world that is only now coming out of COVID and has disposable income that perhaps for the last few years haven't been able to spend, and are now willing to go out there and experience the world again.
Yeah, I can't remember, don't quote me on this figure, but I'm sure I heard something the other day that there are 400 million Chinese travelers who are absolutely chomping at the bit to get back out there and explore, which is going to make a big boost for the hospitality sector. Susan, could you give us a snapshot of the situation in the US in terms of investor sentiment and activity across hospitality and living?
Well, Mr. Powell made a little trip to Congress yesterday and indicated that inflation is nowhere near under control. So we are now looking at probably a 50 bp rate hike increase, which will continue to throw more cold water on the real estate sector overall, not just the hospitality sector. We have seen in the US just recently, meaning in the last 3 or 4 months, actual activity in the hospitality sector again, in interest in hotels. Part of that is because they have recovered from COVID, and the other part of that is if they didn't recover from COVID, they are at the point where they need to make decisions because debt has come due. So we're starting to see a lot more transactions in the space, in the straight hospitality space. In terms of short-term rentals, we've certainly seen that continue to bloom and grow here in the US. It seems to be a very compatible use for versus hotel rooms, straight hotel rooms. It is still hard to get financed here in the US, and there are increasingly more and more laws about Airbnb or VBRO units and what they have to pay in taxes, and how many can be used in a building. But we are seeing them being embraced more and more by developers as part of a unit type in their buildings as they plan new developments, which I think is a good thing.
And how about in the multifamily and co-living sectors? Are they fairly strong?
So multifamily is still the darling of all the asset classes, followed by industrial, retail, then hospitality, and then office at the bottom today. Multifamily rent growth has been great in the US. In 2021, I think was a banner year. It was 6.8% average across the US. A typical year is 3%. So over double what is typical pre-COVID. So it is still held up very strong. I will say, however, that interest cap rates have expanded about 50 bips across the US because of the cost of debt. And because we are anticipating rent growth becoming more normal this year at 3.8%. In terms of co-living, we've certainly seen that industry mature, meaning people have picked a lane. They've either decided they're going to be the Motel 6 or they're going to be the Peninsula. So it's either bare bones entry level, or it's, 38,000 square feet of golf simulators and work from home and infinity pools and blah, blah, blah. Either end of the whole spectrum spectrum of co-living opportunities have held up quite well across the US now that there's a call to be back at work in person, some kind of hybrid event, which has forced people back into urban environments.
Yeah, interesting. That seems to be another parallel with hospitality, where the luxury and economy segments are doing really well, and it's the middle tiers that are struggling. How's the lending landscape, Susan? You mentioned that inflation is going up again. Is it becoming increasingly difficult to get development finance and debt finance for acquisitions?
Assumable debt is very popular today for standing product. If you have debt that is assumable, that it gives the seller a competitive advantage. We have seen lending for standing product fall to about 55% from something that was in the 80s just a year and a month ago. So it has certainly affected liquidity in the marketplace. In terms of new construction, it's typical here in the US to get a 65% loans for construction. That has also fallen to around 55-56%, which means all these deals need a lot more equity to get done today. And as you know, the more equity you need, the less leverage you can have, the more the returns get hammered.
Yeah. Ioannis, you were nodding your head there. Are you finding a similar situation here?
No, I find it interesting. So we, our experience in Europe is that we see liquidity, but it is expensive. So we see that there is lending available, but it's just becoming more expensive. The one thing we do see is that certainly in some of the sectors we were working on, particularly on asset disposals and so on, that at the moment, because of the cost, debt isn't accretive to returns on investments, and so you know, you're looking for buyers who are not relying so much on leverage. So probably there will be less debt being deployed, just because it just doesn't even make sense for a lot of deals to lever as highly as you would perhaps have done in the past. But our development business, I know we have no shortage of offers to continue with it. It's just a bigger cost now on our appraisals when we get started, and it's a consideration as well in terms of timing your start. You know, we've had 3 months ago probably was the perfect storm of the maximum construction cost, the maximum finance cost you could possibly suffer. When we see down the line, we see evidence that all of these become a little bit more calm, and it's about whether you push on or whether you delay a little bit, particularly on the construction, less on the debt. But yeah, certainly we've seen a lot of cost impact.
Yeah, and you have divested an asset recently, but does the fact that finance is more expensive and harder to come by, does that mean you're perhaps holding on to certain assets longer than you originally planned to?
No, not necessarily. I think our strategy generally is we hold these assets to the point that we feel we have stabilized them. So, and they take a different amount of time to stabilize depending on the market we're in and depending on market conditions in the letting cycle. But no, I don't think our investment and divestment strategy is particularly changing because of the market environment. We're always looking at what we have on the books and when is the right moment to exit. We're also looking at whether we have enough opportunity to enter into new assets and new opportunities, and that might drive some of our divestment strategy from time to time. And as I said, in the next 18 months, we do see opportunity to do more deals at the time that perhaps other sectors are less willing to. So that's kind of the drivers rather than the macro environment over the next 2 or 3 years. It's more navigating a fast changing landscape and being nimble to react to opportunity that we think there will exist.
Yeah, thanks, Ioannis. Laura, has KSL's kind of average hold of an asset or a brand changed significantly, or are you more or less sticking to your guns?
Hasn't changed significantly is the short answer. Also, a lot of our, we were very active in 2021 and 2022 in deploying capital. So our investment whole period is still very much the same as underwritten. Naturally, there is the one or the other investment where, we, in hindsight is a beautiful thing, where maybe we're saying now there was a window which we could have used to exit early, which we didn't. But a lot of our investments that fall into that category are very well stabilized, self-sufficient, and like businesses that are very cash generative. So it's not like we're losing out or the return profile is destruct. Those are the businesses, and predominantly those are the businesses I just mentioned that are now very well positioned from a consumer perspective. So I don't want to repeat what Ioannis said. I thought it was very eloquent, and I would echo a number of the points that he made. We're looking at the market. We are actively identifying attractive opportunities. Lenders are interested. What is a special position for KSL Capital is our 30+ year track record in the industry. We're looking back on extremely strong lender relationships whom we have history with. So that we see reflected in some of the term sheets that we are evaluating, which are definitely competitive relative to the wider market spread, I would say. We're lucky, we're active, we're reflecting at all times, like Ioannis said, as to whether or not now is a good market. I do think it's evident that capital is still out there. Some people can be more flexible and creative than others based on the capital partners they have or the capital cost that they are playing with. So I would definitely not say that this is not a market to buy, or so to not sell or buy. It really is a market to sell and buy.
Yeah. And I'm going to ask you to kind of put your finger in the air and have a guess here, but do you think the next sort of year to 18 months is going to be less bumpy than the previous 18 months? I mean, it feels like inflation is slowly starting to get under control here. Do you think things will normalize to some extent?
Oh boy. You're recording this, so I don't want to be called out as being completely off the mark. I mean, we too were reading the news, from the US as Susan outlined. So it's very hard to say. I think we're not going to see the volumes that we have seen in 2021 or 2022. That's just a fact. Second half of 2022. But I do think that people will remain able and capable, interested in deploying capital. I think there will be a segmentation of the market as to, who has the tools available and the flexibility. Yeah. Okay. So volumes coming down, but generally speaking, activity progressing.
Yeah, great stuff. Thanks, Laura. Brian, I want to bring you in here. Another area of segmentation is all about the ESG agendas that are driving investor strategies and real estate company strategies. A lot of companies have set out their stall according to when they want to be net zero carbon. And the way a building is constructed and the way it performs, it's going to have quite a big impact on its value going forward, on its resellability and so on. Can you tell us a bit, Brian, about how investors and developers are addressing this? What measures they're bringing into new buildings and conversions, and how important and how high up the kind of investment tick list it is to have a really well-performing, sustainable building?
Yeah, I mean, first I'd like to say, I'm learning so much about your realm, Laura, Ioannis, and Susan, about this. Obviously, our clients are interested or going through the same thing, experiencing the same headwinds. I suppose when you're trying to plan a development or an improvement, the ideal is always to start from scratch, so you can kind of have control over the quality of every aspect of the development. But you know, I was going to start to say for better or worse, but I think it was actually an opportunity. There's kind of a symbiosis in market uncertainty of, if we have existing assets, do we do anything with them? Do we need to improve them? Or should we look for sites to build new? Should we demolish something? I think there is this opportunity with uncertainty, this biotic opportunity, with actually focusing on what is already built. Because if you're talking purely from the point of view of a decarbonized future, the statistics are that the biggest problem is the existing building stock, not the future building stock. And so, you know, whether it's willful or kind of they have to get on with it to stay in business, our clients are savvy about what their options are these days, even though there's tremendous ambiguity, let's say from a legislative or regulatory pressure on. First of all, no one has all the answers about how to reach net zero, but the people telling us how we have to reach it don't have consensus about how we have to reach it. But I guess at the earliest point, one of our greatest values as architects and interior designers is being able to see an opportunity, whether it's for starting fresh or improving what the existing stock is. So it's kind of like this uncertainty that you're going through is creating a kind of stability in our kind of the projects that we look at, because our clients ultimately have to be flexible.
Yeah, okay. And Ioannis, when you are looking at a new development, or indeed selling one that you've previously developed, how important is the environmental performance of that building in the decision-making process of how you plan it, or the buyer's wish list if they want to acquire it?
I mean, that's changed dramatically in the last few years. I really remember in 2020, we were in the market in the middle of lockdown with a funding deal, and that was the first time ever we got a term sheet from a bank. It was one of the big lenders, and in it said, we will give you this loan provided that the project meets green loan credentials. And I remember reading that and saying, what is this? What do they want now? And it was the context was a complete market meltdown and lockdown. So we thought, that's what do we need to do now? New. But since then, every disposal we are now doing, environmental credentials are in the first round of questions we get in a DD process. They feature in the marketing material we give to investors. They are asked by investors immediately. It's a must-have. It's not a nice to have, and it comes to value. And our attitude is also to embrace that change. At the end of the day, we think it makes not only ethical sense, but complete economic sense to invest in ways to reduce our impact and to change how we design. And it, we work very closely with our design teams and our architects. But we also work very closely with our operations team to see how we do that, not just in the way of the fabric of the building, but also the way we run our business. So we're in the market at the moment, and we're looking at whether we can buy energy farms, or whether we procure green energy, and how we operate the buildings better as well. So massive change. I think for institutional grade stock, it is completely expected to be best in class, and it comes to value, and it pays for itself if you do it.
And presumably, as you say, not only being the right thing to do ethically as an operating company, as well as a development company, and indeed you do continue to operate some of the buildings that you've sold. It just, in terms of the bottom line, it makes a lot of sense to have an efficient building. Yeah,
absolutely. Again, there are things that 10 years ago we weren't looking at, and we now wish we had been looking at, because it's hard to retrofit those things after the building is standing. but I think it's changing dramatically, and it's about how the building is designed. It's about the kit that's in it and the technology that makes it more efficient. It's also about how we communicate with our staff and with our clients, because everyone is a stakeholder in this, and how do we make sure that they also behave in a certain way to reduce our impact on the environment. I've seen a thing, we don't have it in our buildings, but I've seen a thing where just telling the students how much energy they use and their own impact will make them, nudge them into not having the heating on full blast and the windows open. And in some of our assets, students in particular, we have an all-inclusive product. I guess hospitality does as well. You don't pay for your energy bills when you're staying in a hotel or a serviced apartment. But there are ways that you can communicate in a friendly way with the customers, and they receive it well generally, and they play ball.
Yeah, thanks, Ioannis. Laura, did you want to comment on that point?
Yeah, I did. Because I mean, this is a topic I personally feel very passionate about, but I also take great comfort in the fact that at KSL it's a huge agenda item that is now being prioritized. But we spoke about real estate accreditations and the fact that lenders are driving it. But what we're seeing is that our investors, our LPs, are demanding to understand what we do in order to drive our investments forward into this direction, as well as our customers. So our customers, our employees, this is an item that has not like in my short history that has moved from an afterthought in the appendix to becoming front of mind in our reporting, as well as our day-to-day engagement. And so I think we're in the camp of investors who buy businesses, with the exception of one or two in our portfolio that come to mind immediately, where we bring that value to the investment. We are part of the journey of taking them to be certified corporations, sort of Bryan certifications, as well as classifying for green what's the term again? Green compliance with our creditors effectively. But I just wanted to say that I find it fascinating just how much can be done and how much is happening right now in our space. And to Ioannis' point again, how fast the pace of change has happened throughout COVID and since COVID specifically.
Yeah. And Brian, it seems to me that, echoing what the others have said, it's the financial and investment communities that are really driving this. It's not governments, and it's not the end user. It's the money that's driving this process, because they're looking a long way ahead. Does that echo your experience?
Yeah, but firstly, can everyone hear me okay?
Yeah.
Okay, maybe some listeners, I had to bring the laptop a little closer just to make sure everyone can hear me better who are watching. I found myself nodding a lot, to actually everything that Ioannis and Laura was saying, and it's really great to hear that it's no longer the case that there are a lot of people who aren't aware, but there's this amazing awareness that's happened across the sector, across whether public or private stakeholders. But where to begin? The whole idea of, one of the conversations we're having most frequently is there are some developers or owners who want to hold something long term, and then there's some who want to hold things short term, and there's some that kind of make decisions at any given time. And so communication, as Ioannis said, is very crucial to communicating the value, because it's very easy for I think everyone to think that if you're going to go extra, if you're going to do something beyond what is required of you, that there's going to be a cost premium to it. And so then return on investment becomes an interesting question that everyone wants a quick answer to. If we're going to upgrade our windows to triple glazing, if we're going to get mechanical ventilation systems with heat recovery? Are we going to have to shell out for the super duper kind of product? And then there's a hesitancy to kind of proceed with the conversation just based on that, which is natural, it's understandable. But the operational cost savings as a result of taking these measures is really what is at issue here. The savings is part of the return on the investment. I'm sure there were a few other elements of your question, but another thing that I thought of with what Ioannis and Laura was saying was the kind of assets we're talking about on this call, whether it's BTR or student accommodation, co-living, later living, you know, there's this component of shared amenity, and there's this component of, you know, community building. And to me, as a consumer, perhaps, of these types of assets, maybe not later living, hopefully not anytime soon, but I'm wondering what differentiates one from another, and what is the USP? And there are more and more conversations being had about how wearing your sustainable measures on your sleeve is actually a great marketing tool for standing out and differentiating. You know, greenwashing is a serious issue. It's not that it happens out of ill will or deliberateness. I think everyone's capable of having aspirations that might not be practically achievable. But targeting this from the earliest stages, whether an asset already exists or if you're building from scratch, just having that conversation at the earliest stages, when the brief is forming, is really critical to being able to really minimize any perceived cost premiums that result out of any individual components or building systems. And forget about the building. People, you know, have to be drawn to the location in the world where your asset is. And so transportation becomes important, green spaces, a diversity of kind of uses, like if there's a high street and things like that. So, you know, long story short, very interesting times. And it seems like we're all on the same boat.
Yeah. Okay, thanks, Ryan. Susan, I want to move the conversation along to planning and zoning and how that could affect investment decisions. Perhaps you could give us a snapshot of what's happening in the US, because over here we're seeing particularly the newer asset classes such as co-living not particularly well understood by planners, I think it's fair to say, and some projects have become unviable, even though they appear to be on the surface what's needed in a particular area, because the planners are reticent to do something new and something different. Is that the same in the US, or are they kind of further along the journey of awareness of these new asset classes?
Let me make one comment about ESG very quickly, and then I'll answer that. Sure. It says something that Brian Monahan, the CEO of Bank of America, was public this week when questioned about ESG as a component. Could they continue to afford ESG with earnings being hammered because of interest rates? And he said that ESG was a component that was not negotiable, that they would continue to demand that in their investments.
All right.
In terms of zoning and local council. So I know, for example, in Ireland, co-living is, you know, a four-letter word. It's not anything people welcome. Here's what I would say. We run into people who don't understand in the zoning world, who don't understand what the point is in having smaller either micro units or co-living units, or even Airbnb short-term stay units, because they can't put themselves in that position. They wouldn't use it, or they don't use it, which I find actually hilarious, because I don't know that there's very many people who haven't used Airbnb or VBRO in their personal lives. But so what happens is they get defined by minimum standards. The room can't be smaller than this. It's got to have this many parking spaces, which is against every TOD premise in the US or globally. talking about ESG and sustainability. So what we found is we have to do a lot of education on these new projects with our developer clients. And that education takes a year before you can even actually start about a particular piece of dirt with a particular product on top of it. And that becomes, development takes a long time. It's high risk, high reward, but high risk. So anytime you lengthen that time frame, it makes it even harder for development to pencil. But yes, there is an internal bias in general in most zoning places about smaller units. Now, having said that, we are on a kick in the US for what we call ARO, affordable residence ordinances, meaning they have to be at 30, 40, 50, 60% AMI, average median income. We have convinced for our clients some municipalities to use these co-living and micro units as qualifying for ARO units. And that makes a big difference then in their being accepted.
Okay, thanks, Susan. Ioannis, have you guys been in the situation where you would ideally like to build, let's say, a co-living development there, but the local authorities don't want it and would rather you did something they understood better?
I think it's fair to say that, and it varies across Europe. It varies city by city, not even just country by country, how well understood those things are. And it can be completely from a very positive reception to a type of product to a very negative reception. And it's nothing to do with the demand or the supply in the market. You have markets that desperately need a type of product and planners think they're oversupplied. So I think the market has changed quite a lot. There are new forms of new form factors of housing, new types of products, a lot of innovation going on. And I think here in the UK, a lot of it is classed as sui generis, which is everything else, even including student housing, which is, I mean, it has been going for decades now. It is an institutional asset class with billions and billions of transactions every year, and it's still kind of in the everything else category. And that's for student housing. If you start going into co-living and into some of those products, you're even sort of further into the weeds. And if you go into places like Spain, where they're again further behind. So yes, I think being able to communicate what we do is very important, not only to our customers, the tenants, the residents, and so on, and the funders, but also to the planners. And it's never a straightforward exercise. And I think that compounds with a lot of the other headwinds in the market, costs, etc., and gets us thinking, well, it's going to be very difficult for a lot of product to be delivered over the next 5 years. You overlay all of these things, which are planning difficulties, increased costs because of ESG that you now need to build into it, increased finance costs, increased construction costs across the board. I think it's difficult for new entrants who don't have the experience, the lending relationships that Laura was mentioning, and the know-how. It's difficult to see how we will see a lot of product being delivered for the next few years. The economics are there, it makes sense to do it, but it's just increasingly difficult. And the demand outstrips supply and will continue to outstrip supply for some time.
So has your projected pipeline got smaller then in accordance with those trends, or are you still on target to hit what you were hoping to?
We're doing as much as we can. Yeah, we are. What we are doing is we're being perhaps able now to get into locations that we would have had a lot more competition for certain locations, either from different asset classes. You're competing with an office, and maybe some places you could never quite build a living product if office was working 3-4 years ago. Now we can get into those, as well as having less competition from less established operators in land transactions. Or I think the fact that when we go in and bid on something, we can credibly say that we will get it all the way through and get it done and get it delivered, makes us a more compelling partner for people.
Yeah, thanks, Ioannis. Laura, Ioannis's company has got the kind of benefits that come with having the OpCo and the PropCo under the same ownership. And you know, in hospitality, we've seen people move right away from that model in general, apart from a few notable exceptions, extended stay America and so on. And you know, and obviously Brookfield and Locke, who you know well, and you know, there are a few examples of it. Do you think we'll see more companies exploiting the synergies of having the real estate owned by the same company as the operating platform, and is that something that KSL is looking to?
So I'll answer the latter question first. Yes, all of our platforms we own, we wholly own OpCo and PropCo. I think that's a traditional private equity play, which I would say, you know, has increased materially over the last 5 years. So it's and this is, so I'm now adversely answering your second question. It's driven by a number of factors. So it's the level of control, the fact that you can you can affect maximum change, you can control to some degree the timelines, the execution, etc. You can make the decisions, which anyone will know is not the case when you work with third-party operators, and or you know, you rely on a management, like you rely on constructive dialogue with a separately owned management team that may have a very ulterior motive or other motivations than yourselves as the real estate owner. But at the same time, also from a returns capital perspective, owning the business, you know, is an enormous level of risk, which is why we like it, is why, you know, we at KSL feel compelled to get involved. It's what we've been doing for a long time. But then respectively, our expectation is that, you know, and we trust in our abilities, that this will translate into a return profile that is very attractive on exit, because effectively it is the type of work that does require very hands-on engagement, that requires a lot of expertise, that requires time and patience, you know, over the course of 3 to 5 years, in order to then sell a player in the industry that is respected, that could potentially branch into franchises, third-party operation of other real estate owners because of the expertise that we have built. So yeah, I see that continuing, particularly in the private equity space. It's what appeals very much to that investor profile. And anecdotally, I've seen a lot of the private equity players that have moved into Europe in the last 5 to 10 years build out their teams in our sectors, you know, be that PBSA, co-living, traditional hotel, hospitality, travel, leisure. There are now very respectable, sizable teams in this space, continuing to prove out this thesis.
And how much does that strategy affect your ability to kind of grow and scale a platform? Presumably it's a trade-off that you can't presumably grow as quickly as you could if you were an operating company, for example, who was purely operating third-party assets.
Yeah, I mean, I would say to frame that question, it hugely depends on where we are, like whether the market dynamics are playing along. You know, if you're in a time period where capital deployment is really is aided, and I don't want to say easy, it's never easy, but if capital deployment is fluid, then if you happen to be in the luxurious position of owning and operating, then you know your growth is only capped by your own capabilities. So and that's really the practice that I have been enjoying in my career for the last 5-6 years, where that's been the case. We've never been hindered by access to capital, and it was really just a question of how much we could deploy against the people we have invested in and that we were building out in our organizations in order to scale. Now, yeah, if capital deployment is a difficulty, then our platforms find themselves in the exact same position as a third-party operator who's trying to grow, unless of course we branched into asset light, and you know the market was at a period in time where outsourcing the operational aspect was particularly attractive to a real estate owner.
Yeah. Okay. Thanks, Laura. we are nearly at the end of our hour. It's gone past quickly. I want to wrap up by asking you all in turn a question that's come in from Tia Ros. Thanks for your question, Tia. And she asked, if you had $100 million to invest, where would you place it? And she wants to know the location and the type of product. And I'm going to go from left to right as I can see you. So Susan, where would you put your $100 million?
I would definitely put it in the multifamily sector, however you want to define that. It is, for example, in the US is 4 million homes underhoused. We need 4 million just to meet current demand. So I would definitely put it in multifamily. I will tell you that there is a bias in the US across the Sun Belt markets. Sun Belt means Florida, Georgia, the Carolinas, Texas. It now includes Denver and Phoenix. I would tell you that I would invest it in urban environments. I think that's where continued job growth will be. And I think that's where the youth, Generation Z, is going to continue to migrate. And Generation Alpha today is 12 years old. I think that they are going to also migrate into urban environments. So that's where I would put it.
Wow, I didn't realize we'd gone back around to the start of the alphabet again. I must have. Ioannis, how about you?
Yeah, I think for us, probably I would focus probably on the student housing market here in Europe. I think there is a huge structural change in how students are wishing to live, and a huge increase in the number of what we call mobility students, or students who are studying in a different place to the one that they've grown up in. There's a huge kind of movement of people there, so for me that would drive the best returns. The multifamily is interesting. It depends on the market and your view here. I think for us in the UK of affordability, whether you can, the structural undersupply is massively there. For me, it's whether you can get your head around pricing and what people are eventually going to be willing to pay for rent. So in some selected cities and selected types of products would be amazing as well.
Okay, thanks, Ioannis. Laura, how about you?
I'm going to go with my firm's view. I would put it into the luxury space. I think we believe that the markets generally over the last 10 years, the luxury space, there are lots of players that have rested on their laurels and have enjoyed, post GFC recovery with great performance. And then COVID hit and they missed a window to stay relevant and invest. And COVID was, at times very tough on them. So I do think there are a number of players out there from an individual single asset perspective to, some brands that could really benefit from a refresh and investment, because whether I agree with the cause of it or not, there's so much wealth in this world that is looking to deploy. I think across the various generations, we know that everyone is looking for experiences and something special. And so that's where we put our money. And I think I would put my own money behind that as well. I believe in that demand profile.
Thank you, Laura. And finally, Brian, where are you going to put your imaginary, unfortunately, $100 million?
Does anyone know how much a solar-powered yacht costs? Just asking for a friend.
Well, I think you could get one for 100 mil.
Okay, well, if there's any money left over, no, but seriously, as an architect, I would carve that 100 million up. I would put the majority into intensification of urban environments or a higher density where it makes sense, but specifically in mixed use and multi-generational transit-oriented developments. I would focus on designing out as much carbon as possible, both upfront and operational in new builds, and also into retrofit or refurbishments. But that would be the other chunk of money, because the scale of the challenge to upgrade the existing building stock to meet today's, tomorrow's, and later's net zero carbon targets is sublime. It's just kind of who can see the whole picture and how it's going to shape up. So another portion of that money, I think I would put in community-led developments for communities to get engaged in taking action towards building up their respective communities to improve the housing stock kind of from neighborhood to neighborhood.
All right, thanks, Brian. You're spreading yourself a bit thin there, but there's some interesting stuff. Okay, thanks ever so much to Laura, to Ioannis, to Brian and Susan for their input today. I just need to share a few more slides with you. Bear with me 1 second. All right, so the Service Department Awards, which are now in their 8th year, are taking place in London in May. Entries close in less than a week. So if you are in that sector, then make sure you get your entries in. There's no cost to enter. We've got a state-of-the-art online awards platform, and you can enter as many times as you like. The next Urban Living webinar will be a deeper dive into co-living, which is a subject that I'm really interested in. That's going to be a good one. That's on the 5th of April, and you can register for that using the link in the chat. We are also doing the first of a series of half-day face-to-face events on the 29th of March, which will also be looking at the co-living market. And there are subsequent sessions on service departments, on build to rent, on senior living, and so on throughout the year. And you can see details of those in the chat. If you're interested in working with us here at IHM, then do give one of my colleagues a call, Katie or Steph. You can see their contact details on the page there and also in the chat. And finally, thanks for watching. Thanks to our fantastic contributors. Thanks to you for spending your hour watching us. Thanks for your questions. We're going to leave the session open for a couple of minutes while I run a countdown clock, because there's quite a lot of information in the chat that you might want to make some notes of. Yeah, thanks again for watching. Hope to see you on the next webinar, and enjoy the rest of your day. Thanks very much, everyone.
Hello, we are International Hospitality Media, or IHM for short. IHM is